It's kind of funny as somebody that's been in the industry for so long, pushing prediction markets, that people think it's this crazy new concept. And it's been around for a long time, probably 20, 30 years.
The Business of Betting podcast is presented by Optimove, the #1 CRM marketing solution for the iGaming industry. 4 out of the top 5 U.S. operators personalize player experiences with Optimove, the #1 CRM marketing solution for the iGaming industry. Learn more about Optimove by requesting a demo at optimove.com/businessofbetting. And if you like what you see, you will get your first month free.
What is up, everybody? I'm Jason Trost, the host of the Business of Betting podcast. I'm joining in, calling you. I was about to say calling you. I'm calling you live. I'm doing this live. You're going to listen to this recorded. It's a sunny, beautiful day in London. London is just such a different city when the weather's nice. For those of you that don't know or have not had the pleasure of being here for too long, the weather's usually horrible. And when it's sunny and everybody just comes out and so positive, and I am no different. So it's very much a delight to stand on the balcony of my office and get some fresh breeze and see the sun. It's glorious. Today, we're going to do an office hours episode. That's where you guys ask questions and I answer them about the industry. I actually haven't seen these before because I wanted to answer these fresh. So these are going to be off the top of my head. But if you have anything that you want to write in, please send them in and I will try to get them on a future episode. So without further ado, let's kick off this office hours episode with JT. Question number 1. Last week, Illinois shocked the betting industry by passing a last-minute tax change that is the first of its kind, with Illinois operators required to pay a flat rate per bet tax. It was met with unanimous criticism as a short-sighted move that could ultimately push betting back offshore. In response to a new tax, this week, FanDuel announced a surcharge to mitigate the impact on tax on the bottom line, meaning that this cost is being passed directly onto the consumer. What do you make of all this from the perspective of lawmakers, the operators, and the consumers in Illinois? Well, there's a lot to unpack here. So let's start from the perspective of the state, which is probably the easiest. They want to raise tax. They think it's a big state. Chicago's huge. It's a sports crazy country. And also Illinois is completely broke. I don't know what the numbers are, but between the pension funding and the operation of the city and the state, and it's just Illinois, like a lot of places, is out of money. And so the legislation is looking for places where they can raise revenue, and sports betting seems like a pretty easy lemon to squeeze for more tax revenue. So that's their perspective. Ultimately, I think it's a bad idea because, as the question implies, taxes are often passed on to the consumer, and it's just betting is already ripping people off. So it basically rips them off further. It's a little bit like tariffs being a tax on the consumer. This betting tax, even though the legislation probably thinks like, oh, the operator is going to eat this and pay for this. Just like Trump tariffs, they end up getting passed on to Johnny, Mike, and Sue. And, when they go to Walmart to buy their toys for their kid's birthday, they're going to buy more expensive toys. So the legislatures probably are ignoring that fact and just said, whatever, we need the money and this is the right thing to do. Now, in terms of a flat tax on a per bet, this model is really bad for operators because it makes it really hard to do pricing. The best thing for an operator is to pay a percentage of tax of the money that you end up making, because not every bet wins. So like, let's say you had 2 bets, one guy bet $100 and the other guy bet $100. One wins, let's say one wins 200 and one loses his $100. So in this scenario, in both cases, the operator would have to pay tax. But in one scenario, the operator has made $100 and you would pay whatever the 15, 20, 30% tax on that $100 that you made. Or in the case where the operator loses the money, the operator has the possibility of losing more than the amount that was bet. So if $100 was wagered, the operator loses. So the operator in this case would pay, $101 or something like that. So it's got a very uncomfortable feeling from the perspective of an operator. It's kind of thematically not that consistent with good operations, and it's generally kind of a bad way to tax operators. In terms of doing a surcharge, before I get to the tax, there's a federal excise tax. I believe it's 25 basis points. So this tax already does exist. 25 basis points, people kind of roll their eyes and move on with it, but there already is a federal state tax in the United States on sports bets, at least those that are regulated through the states and not the CFTC, but state-regulated sports bets have a 25 basis point tax. Will this push people offshore? I don't think so. I mean, I think offshore is still way bigger than most people give it credit for various reasons, whether it's user experience or lack of KYC or credit. There's a whole bunch of reasons that people are pushed offshore. Usually price sensitivity isn't necessarily one of the top reasons. The offshore guys generally offer more features because they have less regulatory scrutiny and burden. Well, they have no regulatory scrutiny and burden. So I don't think this will push people offshore, but it's not good. I mean, it really, the way to think about this is the consumer is going to get even worse prices, and that's where all this money is going to come from. Question number 2. You were at the SBC Americas conference last month in Fort Lauderdale. Industry conferences like that are usually a good place to get a sense of what the industry is talking about. What did you see as a hot button issue on the show floor, and what was your general takeaways from the conference? Well, basically, the conference this year was noun verb Kalshi, or prediction markets, or CFTC. It's kind of funny as somebody that's been in the industry for so long, pushing prediction markets, that it's now people think it's this crazy new concept. And it's been around for a long time, probably 20, 30 years, going all the way back to Iowa election markets and in trade and trade sports. And this is not a new concept, but it's got a fresh set of paint on it, or a fresh set of wheels, and everybody's very excited about it. The biggest thing, I think the biggest reason people are excited about it is not because it's an exchange. Nobody really cares about exchanges. What they care about is that it lets you do sports betting, potentially, in a federal mechanism, and that is huge. So from one side, I think people are excited because it gives you a way to go into the big states like California, Texas, and Florida unrestricted and be able to offer those services. The downside is a lot of the moats that you might have had, regulatory moats, like the moat in Illinois it's very expensive for operators, or in Pennsylvania or New York with a tax. If the operators are making money under that scenario, they're probably going to fear this thing. And if they're not making money under that scenario because of the regulatory burning, they're excited about it. The other thing, I think the big thing with Kalshi is it's the first time that it's kind of been plugged into the financial technology ecosystem. I mean, sports betting has always been considered the ugly cousin who's not really invited to the family party. But Kalshi has shown that sports betting can be a financial asset class, and people are talking about that. Question number 3. On a recent episode, you talked about raising money from investors up to $50 million. You also talked about a previous funding of $30 million, which you basically spent and then had to restructure markets to bring the costs in line. What would you do differently this time, assuming you secure the funding based on what you learned after raising the last round? There's a lot to unpack with this one, but I would say my simplistic reading on what happened last time is that I overspent when things weren't very efficient. So if you think about a company like a machine, let's use the metaphor of a car company. So I'm car company X, and I want to make a new sedan, and there's probably 5,000 part suppliers and let's say 100 assembly points at my factory. I've never assembled cars, so I might be crazy off with these numbers. But what SmartKits was in 2021 is we were a car factory that was putting out cars, but we were losing money on each car a little bit. That's a little bit akin to like Rivian right now. I think they lose around $80,000 for every car sold. Could be completely off in that number, but something around that number, because the input costs are $80,000 more than the output revenue that they get from selling that unit. And so what you have to do as a car company is you have to optimize all the different steps. Like, can you cut out parts? Can you make this go faster? Can you make the error rate go down? Can you change the throughput of the factory? And my hypothesis in this car factory was all I need to do to have a better car production facility is push things through. But what ended up happening, not to take this metaphor too far, but there was lots of errors with the car, and we couldn't sell them as well. And it just made a bad problem worse when you sort of try to push things without optimization. What this refinancing, this restructuring that we've gone through really forced us to do is go back to the drawing board, look at all of the parts of the business, sort of right size everything, zero-based budgeting, trying to figure out, do we need this, cut everything down to the bone, and then rebuild up. And then you have, like, once things are efficient, then you can increase the throughput of your car factory. So my big lesson for going forward is to optimize the company before spending. The other thing too, which I think because I'd raised $30 million and I was trying to optimize for time, I had this idea that I should spend it. And I think if I raise $50 million, my inclination will be more not be in a hurry to spend it and keep it for a rainy day or for opportunistic things that come up, which they do all the time. It's a little bit like stock trading. If you have a cash portfolio investing stocks and 100% of your cash is tied up in stocks, like when there's a great opportunity that comes along, which it inevitably does all the time, you don't have any cash to kind of jump into that opportunity. So I think that's also important when you raise money for a company to keep some powder dry so that you can opportunistically deploy that capital. Question number 4. It was just announced that Twitter and Polymarket have partnered up to launch an integrated product to deliver data-driven insights and recommendations. As a trader yourself, what do you think about this marriage of prediction markets and real-time sentiment from Twitter? Is this just a gimmicky hook, or do you think this could be a game changer? I think Twitter has more or less become a gimmicky hook. Every time I open it up, it's just getting, I feel like Twitter is, it kind of started with this really high, ideal, interesting place to, it's just bot farms and Russians and angry people. I don't enjoy Twitter very much. I think it's kind of the signal to noise is way out of base. I think it's a bunch of famous people trying to manage their brand, but there's not that much real conversation going on in Twitter. So I don't really see this being very interesting. There's also like, besides seeing the market, there's really not that much quote unquote insight that you do from a prediction market. So it's like checking the price of something. So like if you want to think about this another way, if you hook Twitter in with the price of IBM stock, you're not going to get some unusual insight about the IBM price stock. You're just going to have another way to see what the price of IBM stock is. It's the same with a prediction market. If you have the price of X, let's say the chance of the Democrats winning the House in 2 years, if you plug that into Twitter, you're just going to have the probability which you would have had without Twitter. So I don't see it being super valuable. It's just sort of it's an information syndication play, but it's not anything that's going to change the world. Question number 5. You haven't talked politics in a few episodes, and lots has gone down, especially in the last couple of weeks with Elon's departure from the White House and his fairly public fallout with Trump. Elon took a lot of reputational damage through his Doge side quest, which has gone so far as to damage his company's stock price and market cap. Now that he's out of the White House and repositioned against Trump, can he regain his hero status as the world's most impressive entrepreneur, or has the damage been irreparably done? How do you see all of this? Well, I think like most people, it's really easy to try to put a binary judgment on anything, good or bad. The truth usually is somewhere in the middle. So I'm sure that he's done permanent damage to his brand, and I'm sure he's going to continue being an amazing entrepreneur. So what I think about the Doge, I think the idea of it was very sound. This idea of having smart people from outside government going in, looking underneath the hood to try to make things better and smarter. That is an amazing idea. I've wholeheartedly supported that. The problem is I don't think they did anything in good faith. I think Elon and his team went in there and just kind of fucked shit up, to be technical about it. And this whole quick firing everybody, the government is going to end up spending way more money on that than if they had left it alone, because they're going to have to pay out all these expensive settlements. People are going to sue for their job, and they're going to win because it was firing illegally. And then a lot of these people will have to get rehired back, which they're probably going to be rehired as consultants, which is going to cost more money. So I am really disappointed that I think a lot of the effort was bad faith. I think it was for show. And so I'm disappointed about that, because I think there was an opportunity to bring smart people into government and to try to do things the right way. In terms of Elon and Trump, I haven't talked about it because I'm a little bit repetitive. I think if you know me, I'm pretty anti what's going on with the politics in the United States, and I'm trying to not repeat myself. I'm disappointed in Trump. I think he's bad faith. I think he's a criminal. I think he's a rapist, and I don't think he should be in office, but I think everybody who knows me knows that already, and there's not that much more to say on it. The podcast I personally listen to the most is the All In podcast, and David Friedberg has been talking about deficit for 2-3 years. And I've gone from listening to him talk about it to like, oh, you crazy nerdy guy who's like, like it doesn't matter, to I find myself every time he talks about it more and more nodding my head. And I think the fiscal situation in the United States is almost dire. It's not heart attack time yet, but it's getting there. And I think Trump and Doge had a mandate to do something material about it. And this bill that they have increases the deficit. So not only are they not saving money, but they're spending more money, which just shows the Republicans and Trump, they're a bunch of ass clowns who are not responsible governors, and they're going to make the country in a worse position than when they started. And I'm quite disappointed in that. And in the vein of David Friedberg, I think that most of the powers that be are not taking this problem seriously. And I think there's smart things that you could do to make the government a lot more efficient, a lot smarter, that because of the way private interests work and lobbying and pork barrel spending, unfortunately, the wheels get stuck. And I think Trump had a mandate to do something about it, and he blew it because of Taco. Trump always chickens out, which is, I think, a very accurate way to describe him. Well, that was Office Hour episodes. I'm going to have a date with my wife tonight. We're going to go to the Globe Theater. I'm very excited about that. We're going to see The Crucible by Arthur Miller. I had no idea they had non-Shakespeare plays at the Globe Theater, but I remember reading Crucible in high school. And it's one of those plays that just, if you don't know it, it's about the Salem witch trials. And, it sticks with you because it's so applicable in everyday life. Everybody's always looking for a scapegoat, and witches are very good scapegoats, but it's a great metaphor for blaming other people for your own problems. So with that, I never ask you guys, but please like and subscribe. I hear that a million times on YouTube, and I'm going to say it now. Please give it a 5-star review wherever you consume this podcast. And please send in your questions for future Office Hours episodes or guest suggestions. I hope everybody has a great week ahead, and thanks for listening. Bye.
The Business of Betting podcast is presented by Optimove, the #1 CRM marketing solution for the iGaming industry. 4 out of the top 5 U.S. operators personalize player experiences with Optimove, the #1 CRM marketing solution for the iGaming industry. Learn more about Optimove by requesting a demo at optimove.com/businessofbetting. And if you like what you see, you will get your first month free.